Hi, Ken Wade here. Today we're going to tear apart real estate myth number 3, that it's best to buy and hold for the long term. And while we're at it, let's throw in this other old guru wives' tale, that profits are made when you buy, not when you sell. These common misconceptions are just plain wrong, as I'll prove to you in the next few minutes. I'm not even sure if they were ever true, but they certainly don't work in modern times. My guess is people selling home study courses came up with those cute little sayings to help sell their stuff. They got repeated over time, and now everyone seems to accept them as fact. The first video you saw blew these two myths out of the water, at least for the Las Vegas market. If you haven't seen it yet, that video about the US and Las Vegas real estate market cycles, there's a link below in the right side column. You should watch it because we'll be building on those same concepts in this and future training. What you'll see here right now is that when and where you invest is what determines your success or failure. In fact, in all the examples you'll see today, we just paid full price for an average property, added no additional value whatsoever. We didn't use any special skills to find motivated sellers or buy it right or any of that stuff. You're going to see exactly how one simple change can skyrocket your wealth while slashing your risk and effort, and help you avoid the pain of being in the wrong place at the wrong time like so many investors today. This isn't some magic carpet ride, I promise you. This should be as eye-opening and as real as it gets. Today's training focuses only on backyard investors who stay within a single local market, what I call local market masters. In future videos, you'll see how to unleash the same power nationwide, going from hot market to hot market, riding the wealth-building wave, what I call total market masters. Alright, let's start with Atlanta, Georgia. In this demo, we're looking at it from the eyes of an Atlanta local market master. We'll assume there are only these 3 options. You can buy, you can sell, or you can hold. These results are quite different than what a total market master would get, who's looking to invest wherever they can make the most money in the shortest amount of time and with the least amount of risk and effort. We'll cover total market master investing in a separate video or webinar. Just like we did for Las Vegas on that last video, let's see what we'd make with a simple buy and hold strategy in Atlanta. We'll start with the same $20,000 investment or down payment. We'll get an interest-only mortgage to keep it simple, say for 85% LTV at loan to value, and let's just assume rents cover all your costs, maintenance, taxes, and whatnot. The assumptions aren't critical here because all we're doing is isolating the total automatic appreciation over the period. Then we're going to compare those results to a much better way of maximizing the market using the identical assumptions. So we'll buy in 1980 and we'll sell in mid-2010. For Atlanta, that single $20,000 investment generated a whopping $8,800 return over that entire holding period. While that's better than our Las Vegas example where you lost over $22,000, you're not going to be retiring off of that windfall. Now, how's that saying go about you can't make a silk purse out of a sow's ear? Well, there isn't much there for me to work with in Atlanta when it comes to automatic appreciation. And sometimes the best you can hope for is transactional income if you're not willing to be a total market master and go where the money is, or do nothing. It sure beats working and losing money, or getting upside down and out of options. That can be a real drag on you and your family. What if I could show you a simple way where you could just stick your down payment money in the bank for most of that entire holding period, only putting it to work 2 times investing in real estate, and just sit on the couch eating bonbons the rest of the time if you didn't want to become a total market master investing in other hot markets, and make twice as much for half the effort while avoiding all that downside risk and liquidity? How about 4 times? That's 400% more profit with less work and a lot less risk. Would that interest you? How about 8 times your money? Does that get your attention? Okay, tough crowd. This is my last offer. Would you be interested in making 16 times as much in a crummy market like Atlanta for just a fraction of the work, a fraction of the risk, and a fraction of the hassle all the other Atlanta landlords and real estate investors are putting up with? Remember those red, gray, and green time bars at the bottom of the charts in the last video? The red showed you when to completely avoid the market. The gray showed when it was only good for generating some transactional income, like flipping properties and short sales. Frankly, as an investor, I'm not interested in markets that are in the red or gray phases. It's just too much work, too much downside risk, and not enough upside potential for me, personally. On this chart, we've only highlighted the wealth building period in green. That's the only time in the real estate cycle where you should jump in with both feet and get aggressive. The green shaded areas in this chart show the 2 wealth building phases of Atlanta's cycle over the last 35 years. There was no reason to be invested in Atlanta real estate outside those 2 green areas. And if you were, you lost money. Now about this chart. We all know that anyone can take their crayons and draw pretty green highlighted areas after the fact. But what if you could identify the wealth building periods in any market while it was happening in real time? Think about that. Let's assume for a minute there was some system, some real estate market cycle invention that made it possible to see the start and end points of that green shaded area for every local market in real time, not years after the fact. Here's what that same hypothetical example would produce if you only bought when the indicators told you to and sold when they told you to. You invest the same $20,000. You stick your money in a bank CD until you're ready to use it. In Atlanta's case, these magical indicators all turned green the first time in October 1983. So you bought. Here's what that first indicator would look like in real time. This is the Housing Alert S.T.A.R system, the 6th trigger alert report for Atlanta covering the early 1980s. And it's not magic or imaginary either. It's the product of a lifetime of hard work, trial and error, and some good fortune. You wouldn't even be seeing this had the internet not come along when it did. Looking from left to right for each calendar quarter, there are 6 colored lights. Each light represents a decision trigger or technical analysis event. We'll keep it simple. Just think of it as a traffic light. The first 2 are the short-term indicators, the middle 2 are for intermediate time frames, and the 2 on the right are your long-term triggers or traffic lights. These 6 decision triggers are one of the tools we use to help locate hot or emerging markets all across the country. You can use it as a standalone predictor, as we're doing today, or in combination with other tools and resources inside Housing Alerts. A red light means the market is moving against you. Depending on your specific strategy and time frame, it's time to stop or sell or adopt a more conservative approach like shifting towards transactional tactics. Yellow means what you'd expect, a market in transition. Time to take special notice. Start thinking about changing your strategies in the coming months and proceed with caution. Green means go. The market's moving in your favor. Time to get aggressive. In the next training video, you'll understand why this system in particular and technical analysis in general is the only method possible for predicting real estate cycles and why the alternative, fundamental analysis, can't and won't ever give you actionable decision triggers for your local market. Today, I just want to give you a small taste of the power behind this invention, what it can do for you. We'll cover how it works later. In all these examples today, we're keeping it very simple. There's only one buy and one sell trigger. We buy when both long-term indicator lights in the top right turn green. We sell when either one of the 2 long-term indicators turn yellow. Now, inside Housing Alerts, there are other important tools and methods to help nail down exactly when it's time to get in or out of a market or when to switch strategies, but we aren't using them today. For these examples, we're going to tie one hand behind our back to keep it simple and move faster. Even so, when you see the results, well, they'll speak for themselves. Back to Atlanta and our first buy signal. See how in the most recent time period, assuming we were back in 83, the top row of triggers are all green? That's a good sign. But for our simple rules today, we only care what's happening to the 2 on the top right, the long-term triggers. And you can see that both of these long-term buy signals turned green together for the first time here in the 3rd quarter of 83, activating our one buy rule. So we bought some property. That's a pretty conservative trigger, meaning you may not be first out of the gate or catch the exact market bottom, but it also avoids a lot of risk. As they say, it's the second mouse that gets the cheese. So waiting for both indicators to turn green is the approach we'll be using for all of our demos today. The actual trigger you use depends on your strategy, what's happening in nearby markets, your risk profile, and investment objectives. Now, as a local market master, you'll ride the Atlanta automatic appreciation wave as long as it lasts. You got in 1983, and you got your exit trigger in the 3rd quarter of 88. So you sold and stuck your money back in the bank. You're cashed out of the Atlanta market or switched to a less risky transactional income job. Here's what the exit trigger would have looked like. In this example, we're using a very conservative exit trigger as well. As soon as either of the 2 long-term lights turn yellow, you're out of there. It's as simple as that. You can also see the short and intermediate triggers turning red. They're on the left over the past year or 2. Those were early warning signs that it was nearing time to get the hell out of Dodge. But we waited for our simple rule, the first sign of a yellow light in the 2 right side columns, before we took action. Real estate markets don't usually zig and zag like stocks and bonds. They're pretty easy to predict when you have the right tools. As I mentioned, there are other resources inside Housing Alerts to help monitor the markets, but for this example, we're making it brain dead simple and non-subjective. In other words, this demo is 100% mechanical. There's absolutely no thinking aloud. You could execute the plan just as well as me. A kindergartner could do it. Light turns yellow, you sell. That's it. In the real world, you're allowed to turn on your brain, use your own judgment and all of our other tools, and make more money than what I'm showing you. The next buy trigger happens in the first quarter of 1994. So you buy and ride the appreciation wave until 2002, when you exit. How much better do you think we did, just by avoiding the down cycles? The total profit from this one small change in this one crummy market increased almost 20-fold, from $8,800 to $176,000. You made 1,997% more cash in less than half the time. It turned a measly 1% average annual ROI into a more respectable 44% annual return over that entire holding period. All the other investors in this Atlanta market have been working like a dog with little to show for it. And of course, you don't need cash to invest, and your results could be much better with more sophisticated investing strategies, including all the no money down techniques, or starting with undervalued properties, or doing multiple deals. The key is that when you're in sync with your market cycle, you get much better results because you're letting the market do all your heavy lifting. In a sense, you're just along for the ride. I'll explain why this system is so effective later, but before we leave Atlanta, I want to point out something we'll come back to in another video. See how Atlanta has been in a serious, steady downtrend since 2002? That's a bad sign. It couldn't even muster a feeble bounce any time during the heydays of 2004 to 2007. There's an important lesson in this chart we'll cover in another session. Now, let's look at Los Angeles. Same deal as Atlanta, 20,000 down, buy in 1980, sell in 2010. Your long-term profit was $97,000. That's a lot better than losing $22,000 as you did in Vegas, and better than the $8,800 you just earned from a buy and hold strategy in Atlanta. In fact, if you average that $97,000 profit over 30 years, it works out to an average annual return of 16% per year. That's not too shabby by a lot of measures, but you also had to do some work over all that time, and there's a very big downside risk you take when owning big, illiquid assets like real estate in declining markets. For me, personally, a 16% average return is not going to cut it, especially when there are ways to do much better, much faster, with less work and risk. What if I could show you a simple way where you could just stick your down payment money in the bank for most of that entire holding period, only putting it to work 2 times investing in real estate, and make twice as much for half the effort, while avoiding all the downside risk and illiquidity? How about 4 times more? That's 400% more profit above and beyond that $97,000 buy and hold profit we just saw. We're talking close to $400,000 on a single $20,000 investment, with less work and a lot less risk. Would that interest you? Okay, I'll cut to the chase. How about 20 times more? Yep, instead of $97,000, would you rather make $2 million on that same $20,000 original investment in half the time in a single local market? Let's take a look at what housing alerts could do for you in Los Angeles. We're going to use the same S.T.A.R system triggers as last time. We'll enter the market when both of the long-term indicator lights first turn green. We'll exit the market when either of those 2 lights turn yellow. We're not going to use any other tool, resource, knowledge, experience, gut feel, friends' advice, Ouija boards, nothing. Light turns green, we buy. When one turns yellow, we sell. Remember, we're going to buy an average property, pay full friggin' price, at absolutely no value whatsoever. So our profit comes 100% from the market, automatic appreciation. You didn't do a single thing to impact your profits, except get in at the right time and get out at the right time. This profit is the exact same profit anyone could get. It's available to any and every man, woman, child, or monkey with a deed or who owns or controls any real estate in that market during those times. It's very important you understand this. Automatic appreciation applies to every man, woman, or child with a deed or who otherwise controls any property in that market at that time. No special or any skill is required. If you can buy and sell a house, this can work for you. Any real estate investing strategy or tactic that gives you an edge, allows you to buy below market, sell above market, do more deals, or use less cash will multiply the returns you're seeing here if done in an automatic appreciation market. That's the key. So we get our first buy trigger when both long-term indicators turn green in the first quarter of 1986 for LA. We ride the wave until one of these indicators changes from green, which first happened in the third quarter of 1990. So we cash out then. Here's what those star system indicators would have looked like in real time. See the first buy signal in early '86 when both lights turned green in the top right? You can also see the shorter term indicators on the left turning green in what looks like a pretty orderly fashion leading up to 1986. That pattern, as a standalone pattern, is also a good buy signal. Remember, we're taking a slow, conservative approach by requiring both long-term lights to turn green before we take any action. If you're more nimble or less risk-adverse or have a shorter time horizon, there are other triggers you could use. For example, you could set a buy rule when any 5 of 6 lights turn green, or when the intermediate lights are green for 3 periods in a row, that kind of thing. You can even set decision triggers based on what's happening in nearby markets. If they're all turning green too, you can be more aggressive and get in earlier than if they were red. After doing this for a while, you get a good feel for it, and emerging market patterns tend to jump off the page for you. Same for the downside, setting your exit rules. Here's that first sell signal in the third quarter of 1990, when one of the 2 long-term lights turned yellow. You can also see the shorter-term indicators on the left, all turning red in an orderly fashion. That's another good early warning sign that a sell signal may have been coming. The next buy signal comes in 1997, when both long-term triggers once again turn green. So you reinvest all your profits from earlier and ride the appreciation train once again. You sell when one of those indicators turn yellow, which happened at the end of 2006, so we got out right at the beginning of '07. Here are those traffic lights telling you when to get in and out. See the 2 green lights in the top row right side in the long-term columns? That's our signal to get back in. You can also see the shorter-term signals turning green well before we got our long-term trigger to buy. You had plenty of advance notice things were starting to look good. Okay, now that you see how this part of the STAR system works, I'll zip through these pretty quickly from here on out. You can pause this video by clicking anywhere on it if you need more time to check these indicators out more closely. The LA market remained in the wealth building phase until we got our sell signal, the yellow light in the top row at the end of '06. So we sold at the very beginning of '07. And once again, you can also see the shorter term indicators to the left turning yellow then red, going back 2 years or more. So it was no surprise when it finally came time to cash out of LA. You had plenty of advance notice this was coming. And you start seeing that triangle pattern forming from the top left. In this case, red and yellow. It's a classic pattern, and the long-term indicators usually roll over and turn red like dominoes. Now, I realize this is all brand new for you, but once you spend some time inside and you can see all 30 years of history for each market, it starts feeling as simple as when you're sitting at a traffic light trying to count down the seconds waiting for it to turn green. Frankly, my concern is that I've made it so easy and you can do it so quickly that it won't seem like deciding when and where to buy is the single most important investment decision you can make. Once you invest in a market, you're committed. Your time and attention is now fixed for months and years to come. The way human psychology works is that we all put greater reliance on the things we work at the hardest and the longest. If you spent a solid month doing market research to figure out where or when to buy, you'd put a lot of stock in your research. With housing alerts, you have better, more actionable data in 30 seconds, literally. What you're seeing here in these examples is the foundation for all successful investing. So as we look at the Los Angeles final numbers, and they're pretty shocking, remember why these numbers are so good. Don't let the fact that it's so quick and easy fool you. What you don't see is the gargantuan effort and all the money that's hidden behind these traffic lights and indicators. Okay, you saw the STAR indicators telling us when to get in and out of the market. That's what created the areas shaded in green on this chart. Those are the wealth building phases of the LA cycles, identified in real time, not some after-the-fact retrofitting with a green crayon. So how much did we make in LA by using housing alerts and one small change to our investing program? Take a look at this. Over $2 million. How's that compared to doing it the old-fashioned low-tech way, blindfolded to the market? 97,000 versus 2 million. 2,008,057. What would that be worth to you to work half as much but make 20 times more? Would you pay $100,000 to turn 97K into 2 million? Would it be worth $1 million? Here's what it was worth in Los Angeles, the housing alerts difference. $1,910,723 additional dollars. That's a 10,040% return on your initial $20,000 investment. An average annual ROI of 487% per year for the entire 30-year period. It doesn't take many windfalls like that to be set for life. That's the power of leverage and appreciation when done correctly. That's an outrageous return. And remember, your money was parked in a bank CD, earning a measly 5% for around half that time, with no risk and 100% liquidity. For me, The big money's cool, but controlling your risk is also where it's at. And that's a big part of this system too. I think it comes with age or something. Maybe because I'm in my 50s now and been through 3 market cycles just like the current one, not losing what's taken years to amass is more important, to us old folks anyway, than adding to the pile. Look around. Lives have been devastated by this cycle, just like they were in the last 2 cycles. Even the multi-billion-dollar public real estate companies, run by very bright people, ostensibly anyway, teams of experts, and they still got it wrong. Completely missing the boat, going bankrupt. Folks, it just doesn't have to be that way. Not anymore. In this simple example, you spent 90 seconds every 3 months to log in, see what color the 2 long-term indicator lights were, and took action if they met either of those 2 simple rules. In case you were wondering, no, it's not just a coincidence that these indicators nailed the best times to get in and out. That's what I've been working on most of my adult life to perfect. I should just stop right here. If going from 100K to 2 million in a single market by making one very small change doesn't knock you over with the force of a ton of bricks, there's probably not much more I can say that'll help you see it. This should be your big aha moment right now. I'm hoping it is, just like it was for me in the middle of the night some years ago, while sitting in front of my 8 computer monitors, as I had done day and night for years, creating and backtesting housing alerts, when at 4 a.m. on this special morning, the magnitude of it all brought me to tears. On this night, I had just finished computerizing the entire process. It literally took years working with my programmers. I no longer had to spend days calculating each market by hand. For the first time ever, I could see each city with a single mouse click. It was the first time I had instant access to all the markets, not just the handful I computed manually for myself every quarter. There I was, flipping through city after city after city, comparing my pre-programmed prediction algorithms with the actual results for each city. I was running on adrenaline at this point. Then I got to the end, Yuma, Arizona, and I knew then what I had done, that this invention was going to change many lives, and perhaps the whole real estate investing paradigm. And I started crying. My only regret is that I limited access to only wealthy, sophisticated investors and institutions by pricing it the way I did, and not creating a single city version until now. It could have spared millions of homeowners from financial ruin. Now, I could continue showing you market after market of examples like Las Vegas, Atlanta, Los Angeles, where everything works like a well-oiled clock. But I think you probably have a pretty good feel of what it can do for you, at least if you're a local market master. Can it get any better than this? Yes, it can. If you followed my story from the beginning, you know I originally invented this for my own businesses to help me find new hot and emerging markets, not to maximize when to buy and sell in any specific market. That's why until now, I only had an expensive national version. I'll take you on a tour of that very soon. Here's some of what you'll be seeing in the upcoming training videos. You'll see some advanced uses of the S.T.A.R system. What you saw today, as incredible as it was, is just one simple way to use the 6-trigger alert report. And it's not even the most valuable, or how you can use it to make the most money. We'll show you the TAPS system. TAPS stands for Technical Analysis Point Score. This is far and away my biggest accomplishment and the most valuable tool inside housing alerts. Did you know there are over 5,000 books on technical analysis at Amazon.com? It can get pretty complex. The TAPS system lets you leapfrog over all that and put you in my seat as I analyze every local, state, and regional market automatically for you in a split second. We'll also cover how and why housing alerts work so well, and proof why other methods just can and won't work. This training will be for all the left-brain analytical types like me who need to understand how the engine works, or if you simply want to avoid the decades of costly learning curves that I went through. But if you're like my wife, who just wants to get in the car, turn the key, and drive, you could even skip this one. You definitely don't need to know anything about TA to drive housing alerts. Not at all. And then there's the Total Market Master system. This is it. My raison d'etre, as they say. I'll never invest another way, and you may not either after you see this. If you watched the first video, you know that I'm actually creating these for the members inside Housing Alerts, that your feedback helps me refine the final content that I'll be delivering to them. Think of these free videos as a perpetual focus group testing. I, hopefully, provide you with some really good free ongoing training you can't get anywhere else. And your comments below help me decide what tools and training to add. Enter your email in the box next to this video right now. Click the submit button. You'll immediately get the link to each new video.